The most profitable tech stock ever returned 17,500,000%. That's the sixth best performing stock of all time. In other words, $100 invested in this stock in 1926 would result in over $17.5 million in 2023. Now, I might be giving some hints as to which stock this is based on how old it is, but what we want to talk about today is what led to this spectacular performance, why we're still holding this stock today. We're going to answer these questions, but first let's talk about dividends. So I wanted to point to the snowball effect, and this is something we've covered before, and this chart by Hartford Funds is a great example of many that shows how compounding can affect returns over time. Here you see the growth of $10,000 in the S&P 500, right, from 1960 to 2023, so 63 years of performance. And in the gray there you can see price only, that's no dividends, and the blue shows the total return where you're reinvesting dividends. So going back to 1960, 85% of the cumulative total return of the S&P 500 index can be attributed to reinvesting dividends and the power of compounding. And we, in this piece, talked about how if you invest $1,000 a month into SPY or Bogle's 3 ETF portfolio or your own DGI portfolio, that if you reinvest all those dividends over time, you wait 20 years and you'll be an instant millionaire. So a gentleman who looked at the long-term performance of stocks in a very interesting study that was released just several months ago, this professor here, Hendrik Bessembinder, what he did when looking for the best performing stocks is he took a universe of 29,000 U.S. stocks. So the problem is if you go to a traditional vendor and you start running screens and things like that, it's going to typically omit firms that were acquired or went bankrupt and all that. So this database that he used contains all of that information. He then calculated returns using a buy and hold strategy where each dividend was reinvested into the same stock until delisting. Obviously, if a company didn't pay dividends, then nothing happened there. What he observed here, I think, is probably the most spectacular point of the entire report. It's that 51.6% of stocks realized a negative compound return. So you would have lost money by investing in half of these stocks. That's why here at Nanalyze we focus a lot on identifying landmines that investors, especially newbies, can very easily walk into. He then ranked all these stocks by cumulative performance, and the sixth best performing stock and the highest performing tech stock ever was IBM. Now, this return took place over 98 years, in other words, since 1926. So that's a very long period of time. So it's a fair question to ask, is this good? Well, a piece done by Mr. Aswath Damodaran, a quite notable finance professor, gets a lot of publicity, looked at $100 invested in various asset classes since 1928. Here you can see 3-year T-bills there returning $2,250. You see real estate, $5,000, gold, $10,000. S&P 500, $787,000. IBM since 1926, so a couple of years earlier, returned $17,543,000. So that's quite a spectacular return if we benchmark it against different asset classes. And there's one point to make here, I think, in looking at this list of the top performing stocks. Now, we always want to buy and hold forever if possible. So that's why we set very simple, objective rules that decide when we sell a particular stock that we're holding, whether it's a disruptive tech stock or a dividend growth stock. Now, people will have qualms with this time frame, right? 96 years. Well, you may not be alive for 96 years, but your kids might. So investing in quality companies makes a whole lot of sense. Probably the biggest reason is that you can sleep well at night. Now, when you look at this universe of stocks, there's a 99.99% chance that if you picked by random selection, you wouldn't get any of those top 30 performers. However, if you've invested in our core dividend champion universe, our Quantigence strategy, you'd be holding 11 of the top 30 right now. It's rather interesting. So nearly 14% of the stocks in our Quantigence strategy are among the top 30 performing stocks ever. Or put differently, nearly 37% of the best performing stocks ever are dividend champions. So dividend champions represent some of the highest quality companies out there. That's why the majority of our own capital is invested in this strategy. Now, when we think about technology dividends, all right, this is what makes IBM rather unique. tech disruption happens very fast, right? So investing in tech dividend stocks doesn't make much sense at all. Why? Because a dividend company, by its very nature, believes that the best usage of their capital is return the money to investors, whilst a tech firm should be using that money to accelerate their growth. Now, here on the right, you can see a table that shows all the different sectors in our own strategy, all the different dividend champions, and technology has 3. Now, you could certainly skip that sector. We didn't, and that's why we hold IBM. In retrospect, looking at the available constituents today, Roper actually appears to be a better play than IBM if you were to choose a technology dividend stock. But technology firms always need to be growing and investing in R&D, otherwise they get displaced very fast. The worst case scenario, if they invest marginally, is that they stay competitive. And I think IBM is a classic example of tech becoming irrelevant because perhaps they pivoted too quickly into becoming a value firm and giving back investors a lot of capital that they should have perhaps used to grow the business. And it isn't just that, it's the leadership at the helm. And this is rather remarkable. I had to double check this. Ginny Rometty, somebody who did IBM no favors. We were invested through her entire tenure as a CEO, and she was rubbish, just absolute rubbish. And I think this chart shows why. You can see the decline of IBM since she took over at the helm. You say, well, maybe it was a bad time to be in tech. Well, if you go ahead and look at Microsoft's annual revenue in their current CEO's era from 2014 to 2024, look at how he managed to grow that firm. And then when you look at what IBM has managed to do, you can see that reflected in their share price. So the first comment on this performance chart here, always consider total return with or without reinvesting dividends. So make sure you specify. Here you can see when Ginny Rometty took the helm there in 2014, how the share price just languished. Now, this is not total return. This is price return compared to the QQQ. So what you'd want to do is compare both reinvesting dividends. There's no easy way to do that. I'm sure you'd find that IBM still significantly underperformed the QQQ over time. Now, Microsoft is certainly an example of a company that's both growth and value. And I think in about 6 years, they're going to be a dividend champion. We did a piece on Microsoft that looked at this topic. We downloaded all their dividends and calculated them over time. You can see this 12% compound annual growth rate of their dividends over 18 years. Rather remarkable. Payout ratio is 25%, so 75% of their capital isn't being given back to shareholders. And because they're growing so fast, the dividend yield is understandably quite low, 0.72%. So you certainly wouldn't consider it to be value. And when you think about value versus growth, lots of 25-year-old life coaches throwing around these terms, I don't think without understanding how they're really defined. There's actually a scientific method used to ascribe these labels to stocks, and the labels can change over time. So when we look at value and growth, this is an interesting matrix from MSCI. So I worked there for over a decade and supported these indices. And what's interesting to note here, value and non-growth, you see the quadrant in the upper left there, and in the bottom right, growth and non-value. I think, at least I always thought of stocks as being either value or growth. Well, there's actually a spectrum, and in that spectrum, here at Analyze, we run 2 strategies. Growth is our disruptive growth on the more risky side, and value is far value, deep value, where we invest in dividend champions, and value is overweighted as we're risk averse. But when you look at how they're ascribing these labels, they take a multi-factor approach. It's rather simple. Once you have the data, the stuff's pretty easy to calculate. It's a little more complicated than this, but basically for value, you see 3 values there. Earnings to price ratio, right? So they're looking at valuation for value. That makes sense. Dividend yield, right? So if you didn't have a lower earnings per share and a higher dividend yield, maybe you wouldn't be classified as value. You'd also have some growth. So you see here where you could be classified as value and growth, as in the case of Microsoft, because look at the growth characteristics. You have earnings per share growth. Look at that all the way down. EPS growth, sales per share growth, revenue. and current internal growth rate. Now, this shouldn't be confused with momentum, which often detaches from the fundamentals of a business. So you can see here how Microsoft might be classified as both value and growth, and certainly investors would enjoy aspects of each. Now, you may wonder, where's NVIDIA in the list of top performing stocks? And when we're looking at the top performing stock in terms of annualized returns, okay, now we need to set some rules. So we need to have a minimum time frame. And I think 2 decades of performance really moves past hype to tangible returns over time. Now, for these types of stocks, dividends aren't likely to come into play when you're seeing this sort of performance, because it's in a relatively shorter time frame than the universe of all stocks that ever lived over the duration that they've lived. You're likely to see strong revenue growth and a highly profitable franchise, which will lead to returns such as the highest annualized return when you consider common stocks with over 20 years return data. There's NVIDIA there at the very top with a 33% compounded annual return over 25 years. And then in second place here, you see a firm that no longer exists. They went away in 98. So between 1972 and 1998, this Plenum Publishing Corporation had some spectacular returns. I don't know why. I Googled it real quick and it wasn't very obvious. I didn't give it much time. But below that, see Netflix and Amazon, right? So these are 2 names we're familiar with, and they're certainly not dividend stocks, they're growth stocks, right? And then you can go down the list here and see some other tech names there. But the takeaway here is this. You want to know why NVIDIA sits at the top of that list? Because it has fundamentals that justify that appreciation. And people talk about the next NVIDIA. Well, the next NVIDIA is NVIDIA. And the same holds true for all the next proposals, the next Tesla, the next Microsoft, the next Google. By the next NVIDIA, what you really mean is something that performs as NVIDIA has. This is what a next NVIDIA needs to look like. And here you can see the profits being generated by the NVIDIA cash machine. And whether or not this is sustainable over time remains to be seen, right? So it can justify its current valuations. But what's also important to note here, I haven't said it yet, and it needs to be said, is that past performance is no guarantee of future results. Now, if you want to learn more about IBM, the best performing tech stock ever, we've written a lot about this company over the years. It's rather popular. It's rather interesting. There's lots of hopium on offer in these articles. You can see by the titles here. But our last piece is certainly worth looking at. Is IBM an AI stock? And you see here the last hint, it's not. This last quarter, Wall Street thinks it is. This last quarter, they talk about our expertise in enterprise AI. Okay, not really based on what we've seen. More than $2 billion of bookings since the launch of Watson X. Notice how they simply appended the letter X to the end of the name Watson, which never really did anything. So what's comforting as an IBM shareholder is to know that somebody's at the helm with a plan. And here you can see IBM revenues steadily ticking up over time. They say our 2 key measures of success, revenue growth and free cash flow. Great, right? Revenue growth represents disruptive growth, which we're not looking for in holding this firm. But it's nice to see a tech company growing, right? They should be. Otherwise, they're being disrupted themselves. And dividend growth, IBM's free cash flow, here you can see where it's ticking up there, at least compared to last year. And I really like this example because it kind of makes the whole concept of a payout ratio rather intuitive. So first thing to note, along the bottom, you see there the last 4 years, the dividend has grown 1%. That's rubbish, right? It's not even enough to offset inflation. So their 5-year dividend growth rate of 1.3% is total shite, right? So there's only one reason that we sell a dividend champion, and that's when they stop growing their dividend. So that you notice here, they're very clever. They're making sure that they grow it by the smallest amount every year so they can keep that track record, and hopefully they'll be able to resume that growth fairly soon if everything's on track. See, the preservation of that track record is a priority in the meantime. Now, look here where you see free cash flow. So you have net cash from operations, right? Positive operations cash flows there, which is to be expected, right? IBM's a cash generating machine. And then look, free cash flow here highlighted there. And you can see in 2023, it grew to $11 billion, up from $9 billion in 2022. Of that, they paid, so let's take 2023. They brought in $11 billion in free cash flows, right? That's sitting there. What are they going to do with it? Well, they acquired some companies, you see there. They paid dividends, $6 billion. So if we just look at dividends against free cash flow, you see we've calculated that percentage, 54%. That's not how a payout ratio is calculated, but this is a very intuitive way to look at a firm and say, are they going to be able to continue paying and increasing this dividend over time based on their free cash flows? And it seems that will be the case. They're expecting $12 billion in free cash flow this year. They'll probably raise by 1% like they did before. Well, you also notice debt here, and IBM is taken on a lot of debt, and they also have some cash to offset that, but that's a different conversation. When we look at IBM's Q score, so this is our Quantigence strategy, we use these factors to ascribe a Q score to every dividend champion in our universe. You see IBM scores rather low. I would say anything around 20 is going to be high in our universe there. So they're fairly low. Why? Well, you see two reasons here dragging down their Q score. One is the payout ratio. As I said, payout ratio isn't calculated based on free cash flows, so maybe it ought to be. That's a different conversation, but they're being penalized there. We penalize firms that have a payout ratio that I think hits upwards of 80% or something like that. 5-year dividend growth. If their dividend isn't growing at least as fast as inflation, we're penalizing them, right? And the problem here is that 10-year dividend growth, that's going down that same path. The longer they keep paying 1%, the more likely it is that they're going to get dinged there. So, as I said, we don't sell any dividend growth holding unless the dividend stops growing. So we'll continue to hold on to IBM and smoke the hopium. Some concluding thoughts. Reinvesting dividends produces superior returns over long periods of time, even as short as several decades. We did our own analysis of our strategy's performance in a paper and concluded the same thing. It trounced the S&P 500 using a rebalancing strategy over time. For any applicable asset that produces income, turn on DRIPs. That's dividend reinvestment plans. Your broker ought to support that. Leadership matters. IBM lost its way because of poor leadership. Microsoft found its way because of great leadership. And we're in no position to assess the merits of any leader. People often say, they'll point to some meme stock, some talked about firm and say, oh, the leader's the greatest thing since sliced bread. Unless you worked with him, and even then you'll probably have an axe to grind if the guy's any good. But even if you worked very closely with somebody in the C-level, maybe then you'll be in a position to judge their competency. This is what they call company-specific risk. It's why you don't invest in one single stock. Now, dividend champions appear a lot in the list of top-performing stocks, and this is no coincidence because champions exude quality. Now, I'm going to leave you with another video that talks about the best tech dividend stock we think there is. Please give that a watch. Make sure to sign up to our newsletter in the comments section. There's a link to do that. Thanks so much for taking the time to watch this today.